So as I said, the conversation is going to be right now, it's going to be about the equities market as we count down into February when the 2016 full-year corporate earnings of most of the companies listed on the Nigerian Stock Exchange is supposed to come in. And of course, the usual suspects. The first are the banks. After the banks, we have oil and gas, and then every other person or every other equity turns in their corporate earnings. But what are we expecting from particularly the industrial goods and the insurance indices? Let's talk to Omotola Abimbola, who is an investment research analyst with AfriInvest West Africa. He joins me here in the studios. Good morning to you, Omotola.
Good morning, Harriet.
So it's a very, interesting times, even though we've had this conversation before. But now that the day is here, literally, because it's just less than 48 hours to end January, what are your expectations with regards stocks listed on the industrial and consumer goods indices?
Well, for the industrial goods index, looking at the performance in 2016, we saw that the index was the worst performer of all other sector indices, declining by more than 26%. And the major reason was majorly due to fundamental factors, because we saw that the earnings of companies within that index actually declined in 2016. Talk about the likes of Dangote Cement, Lafarge, CCNN, as well as CAP. So all these companies actually had a weaker earnings performance in 2016. So that had an impact on their share prices in the year. And the major factor that led to this, I would say there are three in number. First was the fact that demand wasn't so high for their products. We saw that for most cement companies, the volume of cement that they shipped out actually fell, up to 9 months 2016. We all know the reasons. The economic activity has been, depressed in 2016. So, for a number of, consumers as well as even, public entities.
But we still had a number of constructions ongoing.
Well, maybe from the public sector side, but one thing we know is this. Nigeria's construction markets, and in fact the cement sector, is mainly dependent on what happens to private investors, whether they are building their houses or not really so much of government spending, so that had an impact on the volume of cement sold by cement companies. And then on the other hand, we saw cost pressures rising as well, due to the, high cost of sales. For cement companies, their major input cost is energy. And during the year, we saw Niger Delta militants attacking gas pipelines, so that led to most cement companies shifting to, much more expensive source of energy, like LPFO, and even some alternative energy mix, so all those had impacts on their cost as well. That's the operating and of course the cost of sales. Then on the financing side of it, we had some of these cement companies that had, lots of foreign currency leverage, like Lafarge, for instance. They had over $300 million foreign currency debt, so as we saw the exchange rates, weakening, in the second half of the year, we saw that they had to book massive, FX evaluation loss, on their foreign currency debts. So all these had impacts on their performance. So Lafarge, they made a loss in 9 months 2016, about 40 billion. Dangote had a decline in profits by more than 10%, CCNN by more than 40%. But going into 2017, we expect the performance for for these cement companies to improve substantially. We have seen cement prices increasing by more than 40%. Last year, we had intense competition in the industry, with prices of cement, coming down to around 1,400 naira per 50 kg bag. That is 25,000 naira per ton. So we have seen cement companies actually increasing their prices to bolster their margins. So that's very positive for the industry. We've also seen, a sort of, negotiation between the federal government and militants in Niger Delta. So that has restored some of the gas pipelines. So we are seeing, cement companies going back to their most preferred source of energy, which is gas. So that's very positive for the industry as well.
But then looking at those stocks, are they properly priced as they are already?
We would say that sentiment in the markets, has been quite bad, due to the foreign currency liquidity that we've had for quite some time now. So we have seen foreign investors leaving the market in drove. So typically, for most stocks in the markets, valuation-wise, the stocks are not appropriately priced. But even talking about fundamentals as well, like I mentioned initially, for cement companies, fundamentals hasn't been too good as well. So we cannot blame it all on sentiment, but also fundamental factors.
Okay, so talk to us a little bit about insurance stocks. It was a very, tepid year. Most investors were quite lackluster towards some of the stocks, except for maybe Consolidated, Hallmark, and ICO, and the rest of it. But that particular index didn't see so much activity. Yeah,
you are right. The insurance index declined by over 11% in 2016. I think the third or the fourth worst performer, of all the sector indices. But I would say that looking at the earnings performance of the companies within that sector, I would say they have been quite modest. We saw, gross premium rating by the companies within our core. We cover 4 companies in the insurance sector. The 4 companies, had increase in their gross premium rating by more than 11%. Their gross premium income increased by more than 30% due to the fact that we had, higher interest rate environments, which means that their fixed income investments are going to deliver higher yield. But on the other hand, we had, cost pressure as well, because claims ratio increased in the industry by about 50% to 60%. So with claims ratio increasing, it had impact on their profitability. But still, we were able to deliver solid profitability performance with the PAC of the 4 companies I mentioned that we cover increasing by close to 40%. But the major factor that led to the drag in their sentiments, it is more of regulatory headwind. During the year, we saw the NICOM, come out with regulation to make sure that insurance companies improve their capital adequacy level. They call it the Solvency II regulation. So with that regulatory change, in their capital adequacy computation, so that would mean that these insurance companies are going to have to capitalize more of their earnings in order to ensure that they keep within the threshold of capital adequacy.
Okay, so as we're taking a look at, as we're counting down to when this company is returning their result,
correct,
what are your expectations? Are we expecting to see, good dividend payout, which is not very likely, or are we expecting to see more losses than, gains, than profits for the year, or an increase in revenue?
Well, I think the performance that we had in 9 months 2016 is quite indicative of what to expect in full year. For the cement companies, we do not expect any change in their fortune, and we do not expect dividend payouts to increase. CCNL, Lafarge, and Dangote Cement, traditionally they are dividend-paying stocks, but for 2016 performance, we do not expect Lafarge to pay dividend because they are trying to capitalize their business right now and try and see how they can convert some of their debt into equity. So that shouldn't, that should probably mean that they're going to, be looking towards trying to make sure that they reinvest all their earnings, all their potential earnings in the future back, because they're even making losses now, so there's no dividends to pay. But for Dangote Cement, we expect dividend payments to continue. The business has been quite profitable, despite the decline in PAC that we saw. CCNN has probably minimal dividend. But for the insurance sector, we do not expect dividend payments to actually be impressive in 2016.
That's if any will come at all.
If any will come at all. But, going to 2017, we expect, a subtle improvements in the insurance markets in Nigeria.
All right. Omotola, thank you so much for coming on the program this morning.
Thank you very much,
and of course, helping us to do this curtain raiser in a very dramatic way. Omotola Abimbola is an investment research analyst with AfriInvest. Well, Business Morning continues in just a moment.